Here's a bold statement to kick things off. The US Federal Reserve's carefully laid plans for interest rate cuts are facing a major roadblock, thanks to stubborn inflation hiding in the latest wholesale price data. But here's where it gets controversial. Are these rising costs truly a sign of inflationary pressure, or just a temporary glitch caused by tariffs and global supply chains? Let's dive in. The Producer Price Index, PPI, a key measure of prices before they hit consumers, surged by 0.9% in July, way above economists' predictions. This isn't just a blip. Trade services inflation, which tracks how much retailers and wholesalers are charging, jumps 2%, the fastest pace in years. And this is the part most people miss. That spike suggests businesses might be passing on higher costs to consumers instead of absorbing them. If this trend continues, we could see a ripple effect in everyday prices, from groceries to gadgets. So what does this mean for the Fed? Well, the central bank had been leaning toward a modest 25 basis point rate cut at its September meeting. But the PPI numbers have thrown cold water on the idea of a larger half-point cut, something Treasury Secretary Scott Bessent recently argued for. Now, investors are bracing for a more cautious approach. And here's the rub. The Fed's 2% inflation target is still out of reach, with the Personal Consumption Expenditures (PCE) price index likely hitting 2.9% annually. That's a big number, and it's not helping the case for aggressive easing. Let's talk about the bigger picture. Federal Reserve Chair Jerome Powell is set to address the Kansas City Fed's Jackson Hole Conference on August 22nd. His speech will be critical. Will he signal confidence in a rate cut, or hint at delays? Meanwhile, Fed officials like St. Louis President Alberto Mussolem are hedging their bets. He's watching for signs that inflation might stabilize, but he's also wary of the lingering impact of tariffs. The effects of higher import taxes might fade in 2 to 3 quarters, he said, but they could stick around longer than we hope. And this is where the debate gets spicy. Should the Fed prioritize fighting inflation or guarding against a potential job slowdown? On one side, Richmond Fed President Thomas Barkin warned that high unemployment could actually help tame inflation. On the other, San Francisco Fed President Mary Daly dismissed the idea of a half-point rate cut as unsupported by current conditions. Even within the Fed, opinions are all over the map. To make matters more complicated, the White House is pushing for a series of rate cuts to bring the benchmark interest rate down from 4.25% to 4.5% to around 3%. But here's the kicker. The Fed is legally supposed to operate independently. Secretary Bessent's comments, while well-intentioned, risk politicizing a decision that's meant to be data-driven. I'm not giving the Fed advice, he clarified, just sharing my analysis. Yet his timing, before the latest PPI report, raises eyebrows. What's next? Investors will be watching 2 key releases, the August jobs report and the PCE inflation data, both due before the Fed's September meeting. These numbers could tip the scales on whether a rate cut is seen as a one-off adjustment or the start of a broader easing cycle. For now, the odds of a 25 basis point cut remain high, around 90%. But the window for a larger move is closing. So, what do you think? Is the Fed's cautious approach the right call, or should it take a bolder stance to prevent a slowdown? Drop your thoughts in the comments. Let's hear if you're team wait and see or team act now.